Today, we're looking at a financial report. It's called CFER Explodes plus 9%. Rocket, is this the next AI superstock?
A very subtle title.
Right? It details CIFR Mining's big pivot into AI infrastructure, backed by some really massive contracts. So let's just dive right in. So the core argument here, as I see it, is that CIFR is going through this pretty significant re-rating. It's transforming into like a hybrid energy infrastructure play.
Yeah.
And what I think works really well is how they establish this double engine idea.
Yeah.
You have Bitcoin mining as engine one, and then HPC and AI hosting as engine two.
And they ground it in these huge guaranteed revenue streams right away. The numbers are, they're big.
They are the $5.5 billion lease with AWS, the potential for up to $9 billion with Google and FluidStack, that immediately grabs your attention.
It really does. It's clearly laid out, and I think that the foundation for the whole thesis is it's robust. They use concrete numbers really well.
Like the cash balance.
Exactly. The $1.2 billion cash balance, the 65% quarter-over-quarter revenue growth, it all helps solidify this idea that the company is sort of decoupling from crypto volatility.
Yeah, they're not just another miner. They're positioning themselves as a serious Tier 1 landlord.
Which justifies that high-conviction title. So the argument for strategic change is definitely there. It's strong.
It is. Okay, so let's get into the feedback. The first point is about structuring the strategic pivot versus tactical news.
Right. This is about the flow of the argument.
We need to look at the section discussing that plus 9.30% move, which was, the warrant redemption.
And the placement of that catalyst, while it's important context for yesterday's price move, it kind of risks overshadowing the much bigger long-term story.
Exactly. The weakness here is that the report jumps from this huge superstock idea right into the tactical news.
It puts the warrant redemption, which, let's be honest, is basically capital structure cleanup before these multi-billion-dollar deals.
And by doing that, you sort of suggest the 9% spike was just about housekeeping. It dilutes the gravity of the actual strategic pivot in the reader's mind, doesn't it?
It completely does. So the suggestion for improvement is really about narrative momentum. It's a simple but, I think, a vital fix. Just resequence the evidence.
You have to build that strategic case first.
Build the maximum strategic momentum before you introduce the tactical catalyst. The AWS and Google deals, that has to be the core evidence. That's what justifies the market excitement.
Right. So for a concrete example, instead of leading with the plus 9.30% move, you lead with the $5.5 billion AWS deal.
And the $9 billion from Google and FluidStack. Firmly establish that Tier 1 landlord status first. Remind the reader that this is about potentially $14.5 billion in contracts.
And then you bring in the warrant redemption.
Exactly. And you frame it as the company maturing its capital structure in response to this new stability. So the story changes from CIFR is cleaning its books to CIFR is now so stable they can afford to clean their books.
It tells a much more powerful story. It's strategic execution leading to tactical maturity.
Instead of the other way around.
Yeah, that small change makes the opening so much punchier. Okay, moving on to our second key area. Let's talk about deepening the distinction of the hybrid model.
Yeah, so the verdict section makes this very bold, very specific claim. It says the company is less risky than a pure miner like Mara, but offers more explosive upside than a utility stock.
That's a fantastic line. It's a great thesis.
It is, but it's a really high bar to clear. To justify that super stock label, the report needs to elaborate more specifically on how the hybrid structure structurally manages that risk and reward.
Right. The weakness is that the connection isn't fully established, between the guaranteed cash flow from the AI side and the super volatile Bitcoin mining side. It doesn't explain how one creates a structural floor for the other.
And Wall Street, it traditionally hates valuing these kinds of hybrid companies because they just don't fit into a neat box. So when you're creating a unique risk profile like this, you have to do the heavy lifting for the analyst, who's used to these pure play models.
The report names the double engine, but it doesn't really show why it creates this specific balance.
Precisely. So the suggestion is to dedicate a whole segment to mapping out that correlation, the counter-cyclical risk management that the AI leasing provides.
It means going beyond just listing the deals,
You have to explain what that guaranteed revenue actually does for the business when crypto is in a bear market. It's about showing the structural hedge.
Yeah, we need a concrete example. Use the data in the report to create a real-world scenario.
So, for instance, you could explain that the guaranteed $830 million in initial revenue from that Google Fluid Stack backstop, well, it ensures operational stability.
Right. It mitigates the impact of Bitcoin cooling off from its high of, say, $70,000 down into the $60,000 range.
That stable cash flow provides a base that pure miners, who might see their entire margin just evaporate in a down cycle, they just don't have it.
And that guaranteed revenue is what structurally justifies why investors should give it a higher, more utility-like valuation. That's the less risky part.
While, and this is key, while retaining the explosive upside from Engine 1, the Bitcoin side.
You have to paint that picture so the reader understands this isn't just two separate businesses running side by side. It's two engines that protect and power each other through different cycles. That structural floor is the key.
It's what makes the whole less risky claim credible. Yeah, that really deepens the insight. Okay, let's move to our final point. This one is about matching the tone of the closing to the thesis.
Oh, yeah. This is a common flaw, I think, in these kinds of high-conviction reports.
You see it a lot.
You do. The aggressive, confident opening and analysis, and then it's all completely undermined by a weak, generic call to action. You promise an AI superstock, and then you end with a whimper.
The problem is just the contrast. I mean, you spend the whole report presenting these colossal data points, reiterating a $30 analyst target. You mention the stock smashing JP Morgan's $18 target.
And then it just ends with, drop a comment below and subscribe for daily updates.
Right. That lack of tailored conviction, it just suggests a generalized pitch, not a focused, urgent investment thesis for a sophisticated audience.
The energy just drains out right at the moment you need to cement that urgency. The closing has to reflect the conviction of the analysis itself.
So, okay, the suggestion for improvement here is to replace that generic sign-off with something more provocative, a high-conviction, forward-looking statement, or maybe a specific research agenda.
Something that cements that conviction and really emphasizes the urgency. You have to focus on what happens next.
Exactly. So for a concrete example, you could focus the closing on the immediate financial hurdles and the known catalysts.
Instead of a generic question, focus on resistance levels and future earnings. Tell the reader what to watch for. Something like, watch for the $20 psychological resistance. If it breaks that, this isn't just a 9% move. It's blue skies to the $25 range.
And we can use the data you already cited to make it more action-oriented. Ask a specific, powerful question that's rooted in the financials.
To drive home the urgency.
Exactly. Something like, what happens to consensus when the estimated Q4 report on Feb 25, 2026 officially reflects the full synergy of that 65% Q3 revenue growth integrated with a stable AWS cash flow?
And then you can add, the market is clearly chasing this price action. The question is, will the major analyst upgrades arrive before the next earnings call or after?
Yeah, that kind of closing shows confidence, and it directs the reader's focus to the immediate high-stakes events. It's a call to action that actually matches the AI Superstock title.
It reinforces that sense that the reader might be late to a massive ongoing re-rating.
That brings us to the end. So to recap, we covered 3 key areas to really sharpen this report. First, resequence the material. Lead with the massive strategic pivot, the AWS and Google deals, and then use a warrant redemption as confirmatory evidence.
Second, explicitly detail how the hybrid model manages risk. Use that $830 million initial revenue figure to show the structural floor that the AI revenue provides against Bitcoin volatility and show why the valuation should be higher than a pure miner.
And finally, make sure the conclusion's tone matches the conviction of the superstock thesis. Replace those generic sign-offs. Focus instead on the imminent catalysts, like the break of that $20 resistance and the next earnings date.
These changes will help make sure the narrative is as robust as the $9 billion potential outlined in the data.
We genuinely want to help strengthen the material. We invite you to submit your work back in again once you've implemented these changes.